During this presentation, you will learn about checking your tax withholding and making estimated tax payments. This presentation was prepared by student attorneys at South Texas College of Law Houston's Low Income Taxpayer Clinic. We provide free legal assistance to taxpayers in Houston, Texas, and surrounding areas. We work with taxpayers who have IRS audits, appeals, tax collection matters, and other tax disputes. If you have an IRS issue, feel free to give us a call at 1-800-646-1253 or email us at taxclinic@stcl.edu. This part of the presentation, you will learn important information about tax withholding and estimated tax payments and the implications of each. First, we will start with a brief introduction of what tax withholdings and estimated tax payments are. Then we will go through how to check and update your withholdings and how to estimate and make estimated tax payments. Tax withholdings are utilized in an employer-employee context. Withholdings is the amount of money that an employer sets aside from an employee's wages. The employer sends the money directly to the government to reduce the amount of taxes that you owe. Estimated tax payments are utilized by those who are self-employed. This is a system used to pay taxes on income that is not subject to withholding. Payments are made quarterly to the government, and they reduce the tax that you owe. Not making estimated payments may result in an underpayment penalty.
First, it is important to understand what pay is subject to withholding. In addition to your regular pay, commissions and vacation pay are subject to withholding. Also, pension, Social Security payments, and withdrawals from retirement accounts are subject to withholding. The amount withheld is based on a variety of information input on your W-4 form. This includes the amount of income you receive, the frequency of your paychecks, your filing status, and the number of allowances you claim. You should remember that the more allowances you claim, the less income will be withheld, significantly raising the likelihood of owing money at the end of the year. You should check your withholding anytime you have a major life change, such as a marriage or divorce, the birth or adoption of a new child, or when you begin a new job. Other good times to check would include whenever there is a change in the tax law or a significant change in your income. If it is necessary to change your withholding, use the IRS withholding calculator to do so. It can be found on the IRS website or simply by searching Google. Once you have determined what changes need to be made, request a W-4 form from your employer and make the necessary changes. Estimated tax payments can be thought of as a substitute for tax withholdings required for certain types of income. They are most commonly utilized by self-employed individuals. Estimated tax payments are made by the individual themselves to the IRS in anticipation of the tax liability that will be due at the end of the taxable year. They can be used to pay not only income tax, but other taxes such as self-employment tax.
Generally, individuals, including sole proprietors, partners, and S corporation shareholders, have to make estimated tax payments if they expect to owe tax of $1,000 or more when their return is filed. You may have to pay estimated tax for the current year if your tax was more than zero in the prior year. See Form 1040-ES, Estimated Tax for Individuals, for more information. For estimated tax purposes, the year is divided into 4 payment periods, called quarters. The quarters are displayed on the screen. Once you've calculated your estimated tax payments, you can pay by phone, by mail, or you can pay online.
Self-employed individuals typically use Form 1040-ES when figuring their estimated tax payments. It may be helpful to use your previous year's tax return as a guide. Here is a quick overview of an example of how to calculate estimated tax payments. Rachel is a self-employed botanist whose annual income is $90,000. Let's start with calculating Rachel's income tax. In order to estimate how much income tax she will have to pay for the year, Rachel estimates her income at $90,000. She then subtracts any above-the-line deductions she thinks she'll incur for the year. This new number is Rachel's adjusted gross income. Then, she subtracts the standard deduction for single taxpayers in 2018, which is $12,000. So, her total estimated taxable income is $63,000. Next, Rachel multiplies her taxable income by her income tax rate. Based on Rachel's tax bracket, her estimated income taxes owed for the year equal $9,799.50. Next, Rachel must calculate her self-employment tax. First, she has to multiply her estimated total income by 92.35%. This is done to adjust her net income downward by the total employment tax that would have been paid by an employer had she not been self-employed. She then multiplies this number by 15.3%, the self-employment tax rate. Next, Rachel simply adds together her income tax and her self-employment tax for the year. She then divides this into quarterly payments. It's important to check your withholding or make estimated tax payments to avoid having to pay a penalty for underpayment. Here are some resources for more information on withholdings and estimated tax payments. Thank you for watching.